People think high interest rates fight inflation by slowing the economy. At least that's the story you've been told, but that is not what actually is happening. For the asset-rich boomer class, high rates don't feel like punishment. They act like a stimulus check, one that boosts disposable income and keeps service sector inflation high. The Federal Reserve didn't cool the economy, they delivered a multi-billion-dollar annual windfall to the wealthiest generation. And you are the one paying for it. This isn't monetary policy, it's a $78.5 trillion demographic heist happening in plain sight. Chapter 1. The $450 billion stimulus nobody voted for. In 2021, a Bureau of Economic Analysis dataset showed American households earning $1.45 trillion in interest income from cash and bonds. By 2024, that total hit $1.9 trillion. That's a $450 billion jump in annual interest income. And that money flows into household accounts every 12 months, with almost none of it requiring anyone to lift a finger. The average NFL team is worth $7.1 billion in 2025, according to Forbes. All 32 teams added together crossed $227 billion for the first time. The interest windfall is about twice that. 1 year of extra checks could buy the entire NFL outright, and you'd still have more than $200 billion left in the bank. $450 billion is bigger than the total annual GDP of countries like the Philippines or Denmark. None of this money required Congress. None of it required a vote. The Fed raised rates and a spreadsheet did the rest. And cash did not get sprinkled evenly. The Fed's own quarterly report on household assets showed that the money flowed into treasury bills, money market funds, CDs, and short-term corporate bonds. Households over 60 hold most of those instruments.
Why do baby boomers control most of the wealth today?
When the federal funds rate moved past 5%, those holdings started paying yields not seen since before the 2008 crash. And that's a problem. The Federal Reserve's stated job is to slow the economy by making money expensive. Borrowing should hurt, spending should drop, and prices should cool. That's the lesson every freshman economics student learns. That lesson describes an economy that no longer exists. Young households with 7% mortgages and 24% credit card APRs got the break. Their parents and grandparents, sitting on $1.2 million in T-bills, got the gas. The Fed pressed both pedals at once, and the people with cash won the trade. Service inflation, the kind that you feel in restaurants and cruise tickets and dentist bills, has refused to come down. The reason is right there in the numbers. You can't cool a market when its biggest customers just got a permanent raise. So here's the question: how did a single age group get strong enough to break the basic rules of monetary policy? The answer took 40 years to build. Chapter 2. Rewind. The demographic bulge. The Federal Reserve publishes a data set called the Distributional Financial Accounts. It tracks how American wealth is split between generations, updated every 3 months. As of May 2026, baby boomers born between 1946 and 1964 hold about $78.55 trillion in net wealth. That is 51.8% of everything American households own. Millennials, the largest adult generation in the country, hold about 9%. That is less than a fifth of what their parents own. Every farm,
Is inflation the real reason younger generations are struggling?
factory, office, hospital, and gas station in the country produced $28.3 trillion of goods and services in 2024. The boomer balance sheet is almost 3 times that. One age group sits on 3 years of total national output. The Federal Reserve has never recorded a concentration like this in the data series, which goes back to 1989. Researchers at the St. Louis Federal Reserve traced the cause to a deeper shift in asset prices. They used a number called the wealth to GDP ratio. It compares everything households own to what the country produces in a year. In the early 1980s, that ratio was about 3.6. Today, it's 5.5. The paper value of the things Americans own grew much faster than the actual products the country made. The shift had winners and losers, and the timing decided everything. A couple bought a Cape Cod in Boston in 1985 for $80,000. By 2020, it was worth $600,000. Someone who bought $10,000 of S&P 500 index shares the year Reagan was inaugurated had over $400,000 by 2024. Compare that to a software engineer who graduated into the 2009 job market. By the time they could afford a down payment, the same house cost 10 times the median income. 40 years of asset inflation does not divide evenly by age. It pools to wherever the assets already are. In 1985, that was the boomers. They didn't plan it. They just happened to be in the door before the rent went up. By 2022, when the rates climbed, you could see the result, a huge
How did the housing market become impossible for Gen Z and millennials?
pile of cash sat in accounts built to benefit from rising yields. Holding $79 trillion is one thing, turning it into an annual paycheck pointed at the working class is a different problem. And that is where this story gets ugly. Chapter 3. The reverse Robin Hood heist. Economists have a polite name for all of this: the interest income channel. The phrase shows up in the Federal Reserve Papers and Bank for International Settlements working documents. The mechanics are simple, and they're brutal if you're on the wrong side of it. When the central bank raises rates, two things happen at the same time. Borrowers pay more and lenders collect that money on the other end. Every extra dollar of mortgage cost shows up as extra interest income on someone else's statement. Money doesn't disappear, it just changes hands. So who borrows and who lends? The Fed's flow of funds report answers without much room for debate. Households under 50 carry the vast majority of outstanding mortgage debt in the country, with Americans aged 40 to 49 holding the highest balances at $3.4 trillion. Most of the student loans and the biggest credit card balances sit in there too. Their parents and grandparents hold all the cash and the money market positions and the short-term treasuries that pay the yield. When the Fed raised rates from nearly 0% in 2022 to 5.5% by 2023, it didn't slow the economy evenly. It hit the brake on one age group and the gas on another. The total spending change came out close to zero. The change in who holds the wealth was historic. The Fed's main weapon against inflation just broke a 70-year promise. Working hard no longer builds a future.
What is the boomer wealth bomb and how does it affect the economy?
Hundreds of billions in new no-risk cash now sits in older accounts. So what are the holders doing with the money? They're spending it on experiences that didn't used to sell out. Chapter 4. The Luxury Paradox. Royal Caribbean Group reported full-year 2024 revenue of $16.5 billion. Net income hit $2.9 billion, and adjusted earnings per share landed at $11.80. CEO Jason Liberty kept using one phrase to explain the run. He called it strong close-in demand. Analysts used a more descriptive name. They called it the Silver Tsunami. Carnival Corporation told the same story. Fiscal 2024 brought an all-time high of $25 billion in revenue and $1.9 billion in net income. CEO Josh Weinstein told investors the boom was being driven by older customers. They were booking premium cabins on cruise ships weeks before sailing at prices that would have looked insane in 2019. The data behind those earnings is consistent. Travel research from Fodor's shows the same trend. Boomers spend nearly 3 times more per trip than Gen Z travelers. They account for 80% of all luxury travel spending in the United States. That figure puts a 4 out of 5 grip on the market in the hands of a single generation. A Royal Caribbean Oasis-class ship holds about 6,800 passengers at peak. The annual dollar volume of boomer luxury travel is enough to fill 1,000 of those ships. That is every cabin, every year, fully booked. It's like a fleet of floating cities stretching from Miami to Reykjavik. The whole thing is funded by interest checks the Fed mailed out. The spending lands right in the inflation data. The Bureau of Economic Analysis sorts consumer outlays into goods and services. Hotels, cruises, restaurants, premium healthcare, and travel all sit in the services bucket. Services inflation refuses to drop toward the Fed's 2% target. Demand keeps building. You can't starve a market when its biggest customers just got handed a raise that they didn't earn. A young household with a 7% mortgage cannot afford a Caribbean cruise. Meanwhile, a retired couple with $1.2 million in treasuries can take 4 cruises a year. They're the ones who set the price. Leisure economy prices respond to who can pay, not who used to pay. The pattern repeats itself across the market. Fitness brand SoulCycle's parent company is reporting record bookings for premium retreats and high-end fitness experiences. Meanwhile, Restoration Hardware has openly positioned itself around older, wealthier buyers, furnishing and upgrading homes with cash.
Why is the global economy looking stable when the wealth gap is rising?
Concierge medicine networks like One Medical and MD VIP have waiting lists for new patients. None of these businesses care where the federal funds rate sits because their customers don't need a loan to buy. And the spending spree isn't contained to vacations and dinner reservations. The same cash flow is quietly destroying the housing market for everyone under 40. Chapter 5. The Cash Buyer Cartel. According to the National Association of Realtors, in 2024, 31% of repeat home buyers purchased their homes entirely in cash. At the national level, ATTOM Data Solutions tracked the same shift. All cash sales reached 32.8% of total home transactions in the first half of 2025. That means nearly 1 in 3 American homebuyers is operating in a market where mortgage rates don't matter at all. In certain markets, the numbers turn surreal. West Palm Beach, Florida, closed 49% of all home sales in cash in 2025. Miami came in at 43% overall, climbing past 65% in the segment above $1 million. In Naples, Florida, iLocal Realtor data and Redfin tracking show cash buyers closed about 60% of all single-family transactions in 2024. The median sale price topped $800,000. Mortgage-dependent buyers in Naples are the people who actually live and work there year-round. They're now boxed out by retirees flying in from New York and Illinois with checks already written. Cash wins on every variable that matters to a seller. It offers speed, certainty, and a clean close with no bank dragging out the underwriting. A split market means 2 pools of buyers, 2 pricing structures, and 2 very different outcomes. High rates only punish borrowers. The 55 and over cohort sits largely outside of the rate environment. They're not financing purchases the same way, and they're often holding assets that benefit from higher yields. Fed policy isn't hurting them, it's paying them. You can't out-earn a cash buyer. You also can't afford the rates being used against you. So the next question stops being about strategy. It becomes about whether the path to ownership still exists for anyone born after 1985. Chapter 6. Root Cause: The Death of Labor. The U.S. wealth-to-GDP ratio is the most important number in American economics that almost nobody talks about. In 1985, it sat at around 3.6. By 2024, it was closer to 5.5, according to the Federal Reserve. The bottom number, what people earn from working, rose steadily.
Why is the global economy looking stable when the wealth gap is rising?
Like it always has. But the top number, what people already own, pulled away fast. That gap didn't widen because people worked harder. It widened because ownership compounds. The economy isn't just rewarding effort anymore. It's rewarding being early. Look at the income data from the U.S. Bureau of Economic Analysis. It tracks something called the labor share of national income. Basically, how much of every dollar earned in the economy goes to wages. In the early 1980s, that number was about 64%. Today, it sits closer to 56%. That difference didn't just disappear, it shifted from paychecks into asset returns. Every percentage point that moved out of wages and into capital is hundreds of billions a year. Returns flow to whoever already controls that pile of assets, not to anyone making new value. America hasn't quite reached the extremes of 19th century Britain's feudal system quite yet, but the trajectory on the wealth to GDP chart is pointing right at it. If labor is dead as a way to build wealth, only one path is left for people under 40. Chapter 7. The Inheritance Trap. According to LendingTree, 78% of Gen Z homeowners aged 18 to 29 got family help to make their down payment. 33% of them said outright that they could not have bought the home without it. The widely cited $84 trillion great wealth transfer is real. It's happening. Cerulli Associates projects the money will move from older to younger generations over the next 2 decades. But the transfer is conditional. It runs through the bank of mom and dad. The people without that bank are being pushed out of the ownership economy. Redfin's 2024 buyer survey said 36% of all Gen Z and millennial buyers received a cash gift from family to close the deal. 16% used inheritance money. The average gift size came in above $50,000. In high-cost metros like Boston and Seattle, gift sizes often run past $150,000. A permanent class of winners and losers is being created, one that's based entirely on birthright. Buyers without family help aren't just buying slower, they are falling off of the ownership ladder entirely. They turn into lifelong renters paying the mortgages of the gifted group through their lease checks. So what kind of society replaces work with waiting? An economy where the timing of a parent's funeral matters more than your day job. The answer is one that we already have. Most people are just starting to figure it out. Chapter 8. The Reckoning. The Demographic Wall. The Census Bureau projects U.S. population changes out 20 years in advance, and they have been consistently right. What it shows is that the generation born between 1946 and 1964 is aging on a fixed timeline. There's no ambiguity, just a known curve moving forward. Actuarial tables already price in when that wealth starts to unwind, not as a theory but as timing. The Federal Reserve has already run models on what that shift does to wealth distribution over time. This isn't something that you need to interpret or speculate about, it's already locked in. Tax reform cannot
What happens to the economy when boomers pass down their wealth?
move $79 trillion fast enough to help anyone currently under 40. A return to zero rates would just reinflate the asset values that caused the gap to begin with. Voting majorities, even if you could assemble them, cannot undo 40 years of asset concentration, and the generation that benefits from the current setup votes at higher rates than anyone else. Only one way out exists, and it's a funeral. The wealth pile described in this report ends when its holders end. Inheritance from Chapter 7 then decides which descendants get the keys. No other off switch is on the table, only time and death can stop the cycle. A wealth tax, if Congress ever passed one, would face constitutional fights measured in decades. The estate tax already exists, but the threshold sits above $13 million per person in 2025. Most boomer estates pass tax-free under that ceiling. The fiscal levers Washington has on the table are too small for a $79 trillion problem. The tools that could actually move the needle require a political coalition that doesn't exist and cannot form. No corporation stole the American dream. No foreign power seized it. The generation that invented the post-war version of the dream bought it in cash. They picked up houses for 2 years of salary in 1972. They then watched those houses become retirement accounts worth 15 years of a young person's salary, and now they collect interest on the cash that funded the heist. The system is working. Just not the way people assume. It's tracking the demographics underneath it. Inflation control isn't broken at the Federal Reserve. It's operating inside an economy where different age groups respond completely differently to rate changes. Same policy, different effects. Housing isn't malfunctioning either. It's being reshaped by who already owns assets versus who still has to borrow to get in. And over time, that difference compounds into a sorting mechanism. Not by policy design, but by birth year. The outcome doesn't really look like a crisis. It looks like a system doing exactly what it's set up to do. It doesn't end all at once, it just plays out slowly, as one generation leaves the system over time. Until then, wealth keeps drifting the same way it already has, more from owning things than from working for them. Effort doesn't disappear, it just stops being the main way money moves. You don't really get a choice to opt out. You just end up where you were born into it. When the boomers exit the system, things change. The wealth, housing, and spending patterns don't just vanish. Find out the real story, and this will happen after baby boomer generation dies off. Or watch this instead.
Want a professional logo or high-quality AI art? I design elite brand identities fast. DM me right now to place your order. How did one generation manage to capture the world's financial future?